annual State of the Markets presentation for Iconic Wealth Management 2018. We are very happy to have all of you here today. Look forward to sharing some important information with you. Take a second, relax, get yourself adjusted, reposition your chair, grab yourself a drink if you need to. And if you do that now, we'll go ahead and dive into everything here shortly. For those who are unfamiliar, my name is Steve Memory. I'm the Chief Investment Officer at Iconic Wealth Management, and I've been in the investment industry for over 20 years now. I'm here to help you gain a clear view of where we are today and where we might go in 2018. If you have any questions, which I'm sure you will throughout the presentation, we're happy for you to ask. We've set up an email address for you to go ahead and send those questions to us directly. It's stateofthemarket@iconic-wealth.com. If you'd prefer to speak with someone directly, feel free to give us a call. Our number is 703-891-9518. We're happy to answer any questions you have to the best of our ability. Now I'd like to draw your attention to these disclosures so I can keep the regulators and attorneys happy. The financial world is incredibly complex, and these days we're all bombarded with dramatic headlines and contrasting opinions. So our goal today is to educate you about what some of the factors we and expert financial analysts are watching. Of course, it would be impossible for us to cover everything, but we will try to touch on the most relevant factors. And while past performance does not guarantee future results, we will focus on trends that may help guide the decision-making process when investing. Here's what we're going to talk about today. What happened in 2017? What other factors affected the markets? What's on the horizon? And what do financial experts forecast for 2018? Let's start off by talking about how to put last year's stock performance into perspective. In 2017, markets soared to new highs on solid economic expansion. The S&P 500, Dow, and NASDAQ all repeatedly broke new records. And with record low volatility, the bull market just kept charging. President Trump's inauguration in January further encouraged the already growing markets. The solid market performances also helped push the Federal Reserve to raise interest rates 3 times throughout the year. During the summer, some investors experienced concern over key events, Hurricane Harvey and Irma, and rising tensions between U.S. and North Korea. A focus on market fundamentals became crucial. Keeping this perspective helped investors to capitalize on the economy's upward momentum. In December, the House and Senate reached an agreement on a tax reform bill that supporters claim will help businesses and boost gross domestic product. On December 22nd, President Trump signed the bill into law. Finally, despite posting losses in the year's final week of trading, all major domestic indexes still ended 2017 far higher than where they began. At the end of 2016, well-known analysts gave their predictions for the S&P 500's performance in 2017. They all predicted that the index would grow, but even the most optimistic target was still off by more than 200 points below the actual results. Ultimately, the S&P 500 went far beyond expectations to close the year with a 19.4% gain. And the S&P 500 wasn't the only domestic index that performed well. The Dow increased by 25.1%, and the NASDAQ was up 28.2%. So we've seen that 2017 brought significant growth to the markets. But let's dig deeper into some of the factors that contributed to performance last year. The labor market, housing, consumer spending, corporate growth, and inflation. 2017 was a solid year for American workers. The unemployment rate dropped to 4.1%, the lowest rate since before the dot-com bubble. And in December, we hit the 87th consecutive month of job growth. While the labor market experienced some volatility due to Hurricanes Harvey and Irma, the unemployment rate remained at a 17-year low. With that said, wage growth has been relatively sluggish. hovering at a 2.5% increase for the year. Understanding the scope of growth in the labor market and where jobs are coming from can be very eye-opening. The total private payroll chart reveals that the economy lost 8.8 million jobs during the Great Recession. During the recovery, we've gained back twice as many, with 17.1 million new jobs created between 2010 and 2017. Where do these jobs come from? Industries related to information, financial services, and professional and business services gained 5.1 million jobs. On the other end of the spectrum, we lost 100,000 government jobs compared to February of 2010. 2017 gave us a lot of positive insight when it came to home sales. The last data available in 2017 comes from November, and it indicates that the industry is performing very well. In November, both new and existing home sales were the highest they'd been in at least a decade. Year over year, existing home sales were up 3.8%, while prices increased by 5.8%. In the same time period, new home sales jumped a massive 26.6%, while prices grew a more modest 1.2%. Even with this huge jump in new home sales, they still represent a lower percentage of home sales than the decade before the housing bubble burst. In other words, new home sales may still have some room to grow. In fact, some analysts believe new home sales still have a good bit of growth potential, which would also benefit the home building industry. Overall, as the economy picks up speed, the housing industry is helping to foster growth. Consumer spending accounts for more than 2/3 of gross domestic product. So the health of individuals' financial lives is an important facet to understand when analyzing economic strength. Judging from recent data, consumers are starting to feel the effects of economic growth and increase their spending in response. As of reports from December 2017, consumer spending had increased 4.5% year over year. Incomes had also gained 3.8% from the same time in 2016. This chart gives a month-by-month breakdown of how much consumer spending and personal incomes have increased in recent months. With the exception of personal income staying flat in June 2017, both measures have been on the rise for over a year. But November's data does give us one potential challenge to be aware of. Spending is increasing faster than incomes. As we all know, spending more than you make can be a recipe for debt. Currently, debt-to-income ratios are near their lowest rates of the last 35 years. But this is one detail that we will continue to pay attention to as 2018 progresses. In 2017, businesses continued the growth we've seen over the past several quarters. During the third quarter earnings season, which is the last quarter we have full data for, 72.8% of companies in the S&P 500 beat their expected earnings, and 68.1% beat their revenue expectations as well. Overall, analysts anticipate these earnings will be 8.4% higher than the same time last year. And while data for the final quarter of 2017 is just starting to come in, the estimated earnings growth is even higher at between 10.6% and 11.6%. If we look at this chart, you can see that corporate earnings have grown since the third quarter of 2016. Analysts at Thomson Reuters expect them to keep rising at least through the second quarter of 2019. Let's talk about inflationary trends for a moment. Inflation is a general rise in the prices of goods and services, and one of the key indicators of economic well-being. Though the relationship between inflation and the stock market is complex, generally speaking, stable, modest inflation is better for equities than high or volatile inflation. If you take a look at the box in the middle of the chart, you'll see several acronyms. CPI stands for Consumer Price Index, and the headline CPI is the most popular measure of inflation. The federal government puts out this data and tracks price trends in a large number of goods bought and sold in the United States. The core CPI below it strips out volatile food and fuel prices, to focus on long-term inflation trends. You can see that the brown CPI line jumps around much more than the yellow core CPI line. That's because food and energy prices tend to be very volatile in the short run. Though the past doesn't always reflect the future, historically, a sudden run-up in prices has often presaged or accompanied a recession. Note the huge inflationary spikes during the 1970s oil crisis and the 1980s recession. At 2.2%, the headline CPI as of November 2017 was well below the 50-year average. In addition, the core PCE deflator, which the Federal Reserve uses as its primary inflation measure, was less than half its 50-year average. At 1.5%, the core PCE deflator is also below the Fed's 2% benchmark. The Fed has a mandate to, quote, foster maximum employment and price stability, unquote. They believe a 2% rate can help support accurate financial forecasting and decisions while preventing harmful deflation. We're confident that the U.S. economy is on the right track, yet we know that the stock market doesn't always follow the economy. One major indicator of economic health is consumer sentiment. Essentially, this is a survey that asks regular Americans how they feel about the economy and their financial prospects. It's an important indicator because sentiment has a strong relationship with consumer spending, and consumer spending drives 2/3 of economic growth. Sentiment can also connect to market performance, but in more complicated ways than you may expect. Consumer sentiment is typically a rational reaction to a strong economy. However, it can also signal irrational investor exuberance when prices climb to unsustainable levels. Historically, recessions sometimes follow periods of high consumer sentiment. We see those recessionary periods on this chart as a vertical shaded area. Is that always the case? No. We can see that it wasn't the case in 1977 or 1984 or 2004, but it did happen in 1972, the year 2000, and in 2007. In October 2017, consumer sentiment hit 100.7. That is the highest reading since 2004. Though consumer sentiment fell to 98.5 in November and to 96.8 in December, it still remains in positive territory. Household finances helped raise consumers' attitudes on the back of a strong economy, low unemployment rates, and high markets. Later in the presentation, we'll offer reasons for this high consumer sentiment reading and why we should stay optimistic about the markets. But we'll still keep an eye on this measurement because it can indicate that a market could trend downward. Like how Warren Buffett phrases, be fearful when others are greedy and greedy when others are fearful. What does that mean for us? Don't get caught up in what others are thinking of doing. Be cautious, watchful, and prudent about managing risk, even when the crowd is going the other way. Before looking forward, let's reflect on the past. Last year, we imagined potential headlines that could happen in the future and gave both optimistic and pessimistic scenarios. From a positive view, we imagined that the stock market would perform well, businesses would invest in the United States, and President Trump's economic policies would help accelerate the economy. We're happy to say these positive predictions came to be in the year 2017. The market continues to hit new record highs, and new economic tax policies are helping drive business. Thankfully, the potential risks we identified in 2017 never manifest. The European Union is still intact, we've avoided potential trade wars, and inflation remains low. By following market fundamentals and avoiding knee-jerk emotional decisions, we maintained an optimistic outlook throughout the year. So we've looked at some of the factors affecting market performance in 2017. Now let's examine the headwinds and tailwinds that could affect the speed and trajectory of the economic growth in the near future. 2018 brings new questions about what the future may hold. If tensions with North Korea ease and the European Union continues to strengthen, new international opportunities may become available. And since the tax reform bill became law, we expect significant economic expansion for this year. In this case, we may imagine future headlines touting major accomplishments a few years from now. Still, we do need to imagine some of the darkest possibilities, so on the other hand, we could have a different picture 5 years from now. If some of the potential risks and headwinds catch hold of our economy, the outlook becomes more concerning. There could be a resumption of trade wars. America could go to war with North Korea, and the European Union could dissolve. Ultimately, no one can predict the future, and 2018 brings a noteworthy amount of political uncertainty. We believe times like these are when you have to focus on the fundamentals and avoid focusing on emotions. We must look at what's really happening in the economy and what the data is showing us. Whether real or imagined, headlines are only helpful if we take the time to think critically and look for truth amid the hype. So, if recessions often trigger bear markets, do we have to worry about a recession this year? Let's look at a good group of indicators that can help ground our predictions in data. This particular slide takes us back to late 2008. Here we see a group of 20 indicators. These indicators help forecast pressures on the economy and financial markets in the next 3 to 6 months. Green is positive for the economy. We could call it a tailwind pushing the economic growth along. Yellow is a caution, and red is a headwind that acts as a brake on the economy. Let's look at where we were in December of 2008. Here we see lots of red on the board. The economy is in serious trouble. The housing market is deep in the red. Volatility is high. The global economic outlook is negative, and business spending is dropping. Now let's look at where we were in January 2017. See a lot more green on this board. The U.S. economic outlook is good. Consumer confidence is high. Corporate profits are growing, and we see many more positive signs. Overall, 16 out of 20 leading financial indicators reported positive or strengthening numbers. There is no red on the screen. Here we are in December 2017. The only negative on the board comes from geopolitical risk. No surprise there. Our testy relationship with North Korea and the Russian collusion investigation have helped keep that particular speedometer in the red. But just as in January 2017, 17 of 20 speedometers on the screen are green. These reflect our economy's strengths and give a positive outlook. Throughout the year, corporate profits rose. The global economic outlook improved, and U.S. economic outlook remained strong. The yellow gauges are areas where analysts have some concerns, and we will continue to watch for developments, especially over the next 3 to 6 months. Though there's still room for improvement in 2018, our economy reflects strength and potential, especially when compared to 2008. Now, the past can't predict the future, and financial markets don't always act in concert with the economy. However, barring some unexpected economic shocks, we're confident that economic growth will continue in 2018. The markets have rallied since the presidential election, reaching one record high after another, but are investors too euphoric? Are equities overvalued? Let's examine this chart to see whether stocks are at a fair value. First of all, P/E ratio means the difference between a company's price per share, or P, and its earnings per share, or E. The higher the P/E ratio, the greater the difference between what investors pay for a stock and what the company actually earns. So a high P/E ratio means stocks are relatively expensive compared to what they are earning per share. If you look at the middle dotted line on this chart, you'll see that the average P/E ratio is 16 times. In other words, over the past 25 years, stocks have averaged a per price share of 16 times their earnings per share. In the Great Recession, the P/E ratio was far below the average line, whereas it was high above the average line during the dot-com boom. By December 31st, 2017, P/E was at 18.2 times, which is above the 25-year average, but still within one standard deviation above average. This data tells us that we do not appear to be in a bubble. Instead, stocks are currently at relatively fair prices for their earnings. So we've established that the PE ratio is higher than the historical average, but still within one standard deviation of this number. If we look more closely at the context, we can see that the current PE is pretty normal for times when inflation is as low as it is right now. In fact, since 1871, anytime inflation has been between 1 and 2%, the S&P 500's PE has been just over 20. At our current low inflation levels then, the 18.2 times PE is actually not too high at all. Now that we've discussed 2017 performance and what economic factors may come into play in the year ahead, let's get down to details that I'm sure you're all interested to hear about. Predictions for the markets and the economy in 2018. As we discussed earlier in the presentation, inflation is below its 50-year average. But what will happen in 2018? Let's take a look at the numbers here. The data shows the Consumer Price Index, or CPI, and reveals that prices are on the rise. Between December 2016 and December 2017, the CPI increased by 2.1%, which is above the Fed's target rate of 2%. When you look at the less volatile core CPI, which doesn't include food and energy, it increased by 1.8% in the same period. The CPI-U is the CPI value for urban consumers, which excludes rural populations. So as we established earlier, inflation is increasing, but at a relatively reasonable rate. The difference comes when we look at the last 3 months of 2017. During the fourth quarter, the CPI increased by 2.6% at an annualized rate. So what does that mean? Inflation increased as the year went on. In 2018, we expect the trend to continue. Prices for housing and services have been increasing, and producer prices indicate that more inflation may be on the horizon. Some analysts believe inflation could hit 2.5% or even higher by the end of the year. In December, the Federal Reserve raised interest rates for the third time in 2017. Currently, their target interest rate is between 1.25% and 1.5%. The Fed currently predicts that if monetary policy changes occur gradually, then economic activity will expand at a moderate pace and labor market conditions will remain strong. That's a quote. The Fed also said they plan to increase rates 3 times in 2018. Ultimately, raising interest rates are a sign that the economy is doing well. But what happens when the interest rates rise? Now let's check the chart. The yellow dotted line represents 5% on a 10-year Treasury note. Now look where the brown diamonds are. They're mostly clustered in the upper left and bottom middle. This arrangement shows us that when rates are below 5%, equities tend to grow with rate increases. But when rates are above 5%, equities tend to decrease in response to rate increases. In other words, history shows us that we may be able to expect the markets to rise even as rates increase, as long as they stay below 5%. Now, how will that affect unemployment? After its December 2017 meeting, the Fed released predictions for GDP and unemployment in 2018 and beyond. As you can see, they predict that GDP will continue its steady, moderate growth, and they expect that unemployment will drop even further in the next few years, hitting 3.9% in 2018. The FOMC here is the Federal Open Market Committee. Now, despite the relationship between wages and unemployment, wage growth has been slower than many people expect. If you look at this graph, you can find 5 different wage brackets, from the lowest to the highest earners. Those in the lowest quintile are experiencing the fastest wage growth, but the higher you go up the income ladder, the slower the pay increases. The data imply that the sluggish wage growth could continue, As a result, the Federal Reserve is unlikely to drastically increase interest rates in order to avoid stalling the economic expansion. So, given all these other predictions, what are the experts forecasting for domestic equities in 2018? Each year, various media outlets compile the S&P 500 price targets of Wall Street's top analysts. Let's take a look at what they have to say about the S&P 500 this year. Now, these targets aren't ours. They're what the experts are predicting. As you can see, their 2018 estimates cover a 750-point range from 2,350 to 3,100. Proof that even experts often have differing opinions. But while they give a range of results, one trend is consistent. All but one strategist are predicting that the S&P will continue to rise in 2018. In fact, just days before the year started, a number of strategists increased their estimates for 2018. Tobias Levkovich from Citigroup, who is listed here, is among them. Of the strategists we've included here, their average estimate of 2863 would be a 7.1% growth. These are strong returns, even if they are less than half of the 19.4% growth the S&P achieved in 2017. Of course, as we said earlier in the presentation, we're not trying to foretell the future. No one knows for sure what equities will do in 2018, and predictions at this stage are pretty foggy. However, these analysts' perspectives show that, for the most part, optimism continues on Wall Street, and with good reason. The wild card in all of this is the new tax law for businesses. What will happen when Apple and other companies start repatriating assets, and will this have a significant impact on GDP growth? Well, as we said, wild card, and we'll have to wait and see. We've gone over a lot today, but if you take away just one detail from our presentation, remember this: emotions have no place in investing. Over the past 9 years, we've weathered so many storms, from the Great Recession to global pandemics to terrorism and beyond. And after all these tests and volatility, the market continues to grow and create new opportunities. Now, the yield curve is a line that plots the interest rates at a set point in time of bonds having equal credit quality, but differing maturity dates. The most frequently reported yield curve compares the 3-month, the 2-year, 5-year, and 30-year U.S. Treasury debt. This yield curve is used as a benchmark for other debt in the market, such as mortgage rates or bank lending rates. The curve is also used to predict changes in economic output growth. Let's reference stock performance since 1980. The average year has a 13.8% difference between its peak and low prices. But if you look at 2017, you'll see that we experienced hardly any variation at all. While the S&P gained over 19% for the year, it only had a 3% intra-year decline. For 13 months, equities have not experienced a pullback over 3%, which is the largest streak of this kind in history. When volatility is low, it can be easy to forget what fluctuating prices feel like. But we want you to remember that larger intra-year declines are normal. An average 13.8% drop can feel unsettling in the moment, but remember, these are often the very opportunities we're looking for. And even with these intra-year drops, the market has been positive in 29 out of the last 38 years. We expect 2018 to bring continued growth in the economy, but volatility may increase. So if you ever feel concerned or want to understand what's happening, lean on us for support. We're here for you. We want to help you make the most of your financial life. So what can you do in 2018 to move toward your family's goals? Well, here are some action items for you. If something changes in your life or personal situation, keep us in the loop. We want to hear about important family events like births and deaths. We also want to know about health issues, your employment changes, and any financial developments, such as an inheritance that may change your situation. And if you find yourself thinking about new goals or reevaluating your priorities, Please share your thoughts with us so we can help you pursue the life you most desire. On top of specific adjustments in your financial life, we also want to know if you experience any change in your feelings about risk, or if you have any concerns about the market environment. We're here to talk through whatever financial questions, worries, or excitement you may have, so we can help you make informed choices and stay on track towards your goals. Finally, we ask that you go over your estate documents, beneficiary designations, and other paperwork to make sure it's all up to date. A well-organized estate is one of the best gifts you can give your family. Throughout 2018, we will focus on delivering the following action steps to you. 1. We're going to keep you informed through our regular communications, our email and newsletters, and our video updates. 2, we're going to manage your investments according to your personalized strategy. If you haven't had the chance to participate in the Riskalyze assessment, let's schedule that and make sure we get that done at the start of this year. 3, as always, we'll stay atop changes in the market environment and make prudent adjustments where necessary. We've gone through a lot of information here and had a thoughtful discussion, but I'm sure a number of you still have lingering questions. So remember, we're a phone call away, or in many cases an email. State of the market at iconic-wealth.com. Happy to go ahead and answer in detail any questions that you have about this presentation or your personal financial situation. If you'd prefer to speak in person, again, our phone number is 703-891-9518. Let us know what your questions are. Let us know how we can better tune this for you. Thanks so much for your time today. As you can tell, I'm passionate about helping you understand the markets and finding facts amidst the hype. For more information, timely updates, follow us on our blog. Check out our website. We're at www.iconic-wealth.com. Make sure you sign up for our email. Check out our videos. And give us a call. We're here to talk. Thank you again. We hope you've enjoyed the details we've shared today. And if you have any questions, please reach out. Thank you very much.